It's January 2030. You're sitting at a coffee shop, scrolling through your phone, when you overhear two people at the next table talking about their portfolios. One of them mentions they just crossed $400,000 in investments. The other laughs and says they're close behind. They look about your age. They're wearing the same kind of clothes you wear. They probably make similar incomes. And yet somehow they're sitting there casually discussing wealth that you can't even imagine while you're quietly calculating whether you can afford a second coffee. What happened? Where did the split occur? My name is Tom, and I've spent the last 15 years studying how ordinary people build wealth, and more importantly, why most people never do. What I've discovered is that the difference between financial freedom and financial stress almost never comes down to income, intelligence, or luck. It comes down to timing and action. And right now, we're living through one of the most critical timing windows in modern economic history. If you're someone who's been telling yourself you'll start investing soon, or you've been waiting for the right moment to get serious about your financial future, this video is going to show you exactly what's at stake. Make sure to subscribe and hit that notification bell, because what I'm about to share could genuinely change the trajectory of your next decade. Here's the uncomfortable answer. The split already happened. It happened 5 years ago, in 2025, when both of you were watching the same videos, reading the same articles, seeing the same warning signs. The only difference is what you did next. This isn't a video about motivation. I'm not going to tell you to hustle harder or believe in yourself. This is a video about a window that's closing not slowly, not eventually, but within the next 5 years, and what happens to people on either side of that window when it shuts. Because the economy you're living in right now, the one where someone with no connections and no inheritance can still build real wealth through smart decisions and consistent action, that economy is changing faster than most people realize. And the people who understand what's coming are moving. Right now. Today. The question is whether you're going to be one of them. Let me show you two futures. Both start from the exact same place. Maybe it's where you are right now. Same income, same debt, same confusion about what to do next. The only variable that changes is what happens over the next 5 years. Future A is the path of delay. In Future A, you watch this video and feel a flicker of motivation. You think about opening that brokerage account. You consider cutting back on a few expenses. You tell yourself you'll start investing next month after things settle down. But next month comes with its own problems. There's a car repair, a birthday gift, an unexpected bill. The market looks uncertain. Your friends aren't really investing either, so maybe it's not that urgent. A year passes. You've saved a little, maybe a few $1,000s, but it's still sitting in a checking account earning nothing. You tell yourself you're being responsible by keeping it liquid. Meanwhile, inflation is quietly eating 3 to 5% of that money every single year. You're not losing money in the traditional sense. The number on your screen stays the same, but what that money can actually buy is shrinking every month. By 2027, something else starts to change. You start noticing that certain jobs are disappearing. Not dramatically, not all at once, but steadily. The entry-level positions that used to be available for people switching careers or starting over are getting automated. The freelance gigs that used to pay decent rates are getting undercut by people using AI tools to do the same work in a fraction of the time. The arbitrage opportunities that used to exist for anyone willing to work hard are getting squeezed. And here's what nobody tells you about technological disruption. It doesn't announce itself with a warning bell. It creeps in gradually. And by the time you realize your skills are less valuable than they were, the window to adapt has already narrowed. By 2028, you're still working, still earning an income, but you notice something troubling. Your raises aren't keeping up with the cost of living. Your rent keeps climbing. The dream of buying a house has quietly transformed from in a few years to maybe eventually to something you don't really talk about anymore because it's too painful to think about. Meanwhile, you keep hearing about people your age who are doing fine. More than fine. They're buying property, building portfolios, taking vacations without checking their bank account first. And you can't figure out what they're doing differently. Because on the surface, their lives look just like yours. Same jobs, same cities, same starting point. But somehow, they ended up somewhere completely different. By 2030, the gap has become a canyon. The people who own assets, stocks, real estate, anything that generates returns are watching their wealth compound. Not because they're smarter or luckier, but because they understood one simple truth 5 years earlier. In an economy where currency keeps expanding, the only way to stay ahead is to own things that benefit from that expansion. And the people who kept their money in savings accounts, who waited for the right time to invest, who told themselves they'd figure it out later, they're not broke, they're just stuck. Their income covers their expenses, barely. They have no margin for error. One job loss, one medical emergency, one unexpected expense, and they're in crisis mode. They've become completely dependent on their next paycheck, with no assets working in the background, no passive income, no safety net. This is Future A. It's not dramatic. It's not a catastrophe. It's something worse. It's quiet stagnation that feels like normal life until you look up and realize you've been running in place while everyone else was moving forward. Now, let me show you Future B. Same starting point, same income, same debt, same confusion. The only difference is what happens in the next 6 months. In Future B, you don't wait until you feel ready. You understand that readiness is a feeling that never fully arrives, and that the people who build wealth aren't the ones who felt confident. They're the ones who acted anyway. You open an investment account, not because you've mastered the stock market, but because you understand that the cost of waiting is higher than the cost of learning as you go. You set up an automatic transfer, maybe it's $200 a month, maybe it's $500, maybe it's more. The exact amount matters less than the consistency. Within the first year, something shifts in your psychology. You stop thinking of yourself as someone who's trying to save money and start thinking of yourself as someone who invests. That identity change sounds small, but it affects everything. You start noticing opportunities you would have ignored before. You start making decisions based on long-term growth instead of short-term comfort. By 2027, while Future A is watching their purchasing power erode, you've accumulated a portfolio that's actually growing. Not dramatically, we're not talking about getting rich overnight, but steadily. The compound interest that seemed theoretical in 2025 is now visible in your account. You can see your money working even when you're not. And here's where something interesting happens. You start to notice the same technological changes that are threatening Future A, but you experience them differently. When AI tools become widespread, you're not afraid of them. You're using them to become more productive, to learn new skills faster, to compete at a higher level. The same forces that are squeezing people who waited are accelerating people who position themselves early. By 2028, you've crossed a psychological threshold. You have enough invested that market fluctuations don't scare you anymore. When prices drop, you don't panic and sell. You see it as an opportunity to buy more at a discount. You've developed what I call financial resilience, the ability to absorb setbacks without derailing your entire plan. And because you're not living paycheck to paycheck, you have options. When a better job opportunity appears, you can take the risk of switching because you have a cushion. When you want to negotiate for a raise, you're negotiating from strength instead of desperation. The money you invested didn't just grow, it changed your relationship with risk and opportunity. By 2030, while Future A is stuck at the coffee shop wondering how everyone else got ahead, you're one of those people at the next table, not because you got lucky, not because you had some secret advantage, but because 5 years earlier, you understood that the window was closing and you decided to move. So what's actually happening? Why is this 5-year window so important? There are 3 forces converging right now that are unlike anything we've seen in previous generations. The first force is the accelerating expansion of money itself. Central banks around the world have been printing currency at historically unprecedented rates. A significant portion of all US dollars in existence were created after 2020. This isn't a political statement, it's just mathematics. When you dramatically increase the supply of something, you decrease its relative value. This means cash sitting in a savings account is losing purchasing power every single year, while assets like stocks, real estate, and other investments tend to rise in nominal terms. In other words, the game has changed. The old advice about saving your way to wealth doesn't work the way it used to because the money itself is changing. Every dollar you save today will buy less in 5 years unless that dollar is invested in something that grows faster than the currency dilutes. The second force is artificial intelligence. And this one is harder to fully grasp because we're in the middle of it. What used to take months to learn can now be learned in weeks. What used to require expensive professionals can now be done by anyone with the right tools. On the surface, this sounds like democratization, and it is. But it also means that the advantages people used to build through years of skill development can be compressed or eliminated overnight. If you're someone who relies purely on selling your time and labor, this is a threat. The value of basic skills is declining because those skills are becoming automated or commoditized. But if you're someone who owns assets, stocks, and companies that benefit from AI, real estate, intellectual property, or other productive investments, this technological wave works in your favor. Your capital becomes more productive even as human labor becomes less differentiated. This is why there's a growing split between asset owners and wage earners. It's not about intelligence or hard work. It's about which side of the equation you're on when technological change accelerates. The third force is the compression of opportunity windows. In previous generations, economic mobility happened gradually. You could start late, make mistakes, recover, and still build wealth over a lifetime. The timeline was forgiving. But today, the gap between early actors and late movers is widening faster than ever. The people who started investing during the pandemic recovery captured gains that latecomers will never see. The people who learned to use AI tools early have advantages that are compounding, while others are still debating whether to learn. The people who bought property before the latest surge are in fundamentally different positions than people trying to buy today. This pattern will continue. The returns to being early are increasing, and the penalties for being late are becoming more severe. That's why the next 5 years matter more than the previous 20. Let me be specific about what this looks like in numbers, because abstract concepts only go so far. Consider someone who starts investing $400 per month today at age 30. Assuming average market returns of around 8% annually, by age 50 they'll have roughly $235,000. By age 60, that grows to over $590,000. By 65, they're approaching $900,000. And that's without ever increasing their contribution. Just $400 a month, consistently, for 35 years. Now consider someone who waits until age 35 to start. They invest the same $400 per month. By 65, they have roughly $550,000. The 5-year delay cost them $350,000 in final wealth. Not because they invested less per month, but because they gave compounding less time to work. But here's where it gets even more dramatic. Remember those 3 forces I mentioned: currency expansion, AI acceleration, and compressed opportunity windows? Those forces mean the next 5 years of returns might not look like historical averages. If you're positioned in the right assets during a period of rapid technological growth and monetary expansion, your gains could far exceed what previous generations experienced. And if you're sitting in cash during that same period, you're not just missing gains, you're actively falling behind as the purchasing power of your savings erodes. This isn't about getting rich quick. It's about understanding that the math of wealth building has fundamentally changed, and the people who recognize this early have a structural advantage over those who figure it out later. So what do you actually do? Let me walk you through the practical moves that separate future B from future A. First, you have to accept that perfect knowledge is a trap. You will never feel fully ready to start investing. You will never have complete certainty about which assets to buy. The market will always look risky because uncertainty is literally the price you pay for returns. The people who build wealth aren't the ones who waited until they understood everything. They're the ones who started with imperfect knowledge and learned along the way. Open a brokerage account this week. Not because it's the optimal moment or because you've researched every option, but because the act of starting changes your psychology. You shift from someone who thinks about investing to someone who invests. That identity shift is worth more than any amount of additional research. Second, automate your investing immediately. The biggest enemy of wealth building isn't market crashes or bad timing, it's your own decision fatigue. Every month that you have to manually decide to transfer money into investments is a month where you might not do it. But when the money moves automatically, before you even see it in your checking account, investing becomes effortless. Set up an automatic transfer on the same day your paycheck arrives. The amount should be uncomfortable but not unsustainable enough that you notice it, but not so much that you have to turn it off. For most people, this is somewhere between 10 and 20% of their income. If that feels impossible, start with 5% and increase it by 1% every few months until you hit your target. Third, keep it simple and boring. The investments that actually build wealth for regular people aren't exotic or exciting. They're broad market index funds that own small pieces of hundreds or thousands of companies at once. When you buy a total stock market fund, you're not betting on any single company. You're betting on human productivity and innovation continuing to grow over time. That's a bet that has paid off for over a century. Don't try to pick individual stocks. Don't try to time the market. Don't chase whatever asset class had the best returns last year. Just buy broadly diversified funds, hold them for decades, and let compounding do the work. Fourth, protect your position during volatility. The biggest mistake new investors make isn't buying the wrong thing, it's selling at the wrong time. Markets decline sometimes. That's normal. But the people who panic and sell during downturns lock in their losses, while the people who hold steady and keep investing end up buying more shares at lower prices. The key to surviving volatility is having enough emergency savings, 3 to 6 months of expenses, in a separate high-yield savings account. That money exists specifically so you never have to sell investments during a downturn. It buys you the psychological freedom to stay invested through temporary declines. Fifth, and this is the one most people skip, you need to actively increase your income while simultaneously investing. The people who build serious wealth in short time frames aren't just optimizing their spending, they're aggressively growing what they earn. In a world where AI tools are making skills easier to acquire, there's never been a better time to learn something valuable and monetize it. Look at your current skill set. What could you learn in the next 6 months that would make you worth more to employers or clients? What side income could you create that adds another stream of revenue? Every additional dollar you can earn is another dollar that can compound for the next 30 years. Here's something I want you to sit with for a moment. The gap between future A and future B isn't created by dramatic differences in behavior. It's created by small, consistent differences in behavior, compounded over time. Future B doesn't require you to be brilliant. It doesn't require you to have wealthy parents or special connections. It requires you to do a few simple things that most people don't do, not because they can't, but because they convince themselves they'll start later. The person who invests $400 a month starting today is not making a dramatic sacrifice. They're choosing a slightly different allocation of resources. They're buying fewer things that don't matter, so they can own more assets that do. Over time, that slight difference compounds into a completely different life. And here's the part that keeps me up at night when I think about this window closing. The people who are already positioned, the ones who started investing years ago, who own real estate, who have assets generating returns, they're not going to suddenly become worse off. The wealth gap isn't going to reverse. If anything, the advantages of being early are going to compound, which means the cost of being late gets higher every single year. We may be approaching an economy where economic mobility becomes dramatically harder than it was for previous generations. An economy where your position in 2030 is largely determined by the decisions you made between 2025 and 2030. That might sound alarmist, but look at the trends. Rising asset prices, expanding money supply, AI-driven productivity gains, accruing to capital owners. All of these forces point in the same direction toward a widening gap between those who own productive assets and those who don't. The window isn't closing because someone wants it to close. It's closing because the nature of the economy is changing, and change favors people who adapt early. So here you are, January 2025, 2026, wherever you are in this timeline. You've just seen two futures laid out in front of you. Future A, where you tell yourself you'll start later, where each year of delay costs you more than you realize, where you wake up in 2030 wondering how everyone else got ahead while you stayed in place. And future B, where you start now, imperfect and uncertain, where you let small, consistent actions compound into something significant, where you position yourself on the right side of the forces reshaping our economy. The only thing standing between you and future B is a decision, not a perfect decision, not a fully informed decision, just a decision to move now instead of waiting for a certainty that will never arrive. 5 years from now, you're going to be somewhere. The question is whether you're going to be in that coffee shop listening to people talk about their portfolios or whether you're going to be one of the people talking. The math doesn't care which one you choose. Time keeps moving either way. The only variable is what you do next.